Good morning/afternoon, everyone. Thank you for joining us today as we dive into a critical topic: understanding and combating fraud in financial and legal contexts. In this presentation, we'll take an in-depth look at the risks associated with fraud, how to detect it effectively, and the best strategies for prevention. We'll specifically focus on cases involving bankruptcy, tax issues, and money laundering. I'm excited to share this important information with you and explore how we can work together to tackle these challenges. Fraud is particularly common in situations like bankruptcy, divorce, and tax cases because these scenarios often involve opportunities to manipulate assets. In these cases, there are usually significant financial stakes at play, which can lead to complex transfers of assets. The intricate nature of these transactions makes it easier for deceptive practices to occur. Ultimately, the motivation behind this fraud is typically to conceal or misrepresent assets in order to gain a financial advantage or to reduce liabilities. Understanding these key points helps us see why fraud is so prevalent in these specific circumstances. Bankruptcy is regulated by the U.S. Bankruptcy Code, which establishes the rules and procedures for handling insolvency cases. This legal framework is crucial for ensuring that the process is orderly and fair. However, fraud risks arise when individuals or entities attempt to conceal, transfer, or undervalue assets to avoid paying their creditors. These deceptive actions undermine the integrity of the bankruptcy system, making it harder to distribute assets fairly among all stakeholders. Ultimately, fraud complicates the process and threatens the transparency and equity that the Bankruptcy Code aims to uphold. When it comes to fighting fraud in bankruptcy cases, there are three key players we need to understand. First, we have the trustees. Their main job is to oversee how assets are distributed to creditors, making sure everything follows bankruptcy laws. Then we have auditors, who dig into financial records looking for any inconsistencies or irregularities that might suggest something's off. Lastly, investigators take a deeper dive. They conduct thorough inquiries to find any hidden or transferred assets and expose fraudulent behavior. What's really important here is how these roles work together. Their collaboration is crucial to maintaining the integrity of the entire bankruptcy process. When we talk about tax fraud, it's important to distinguish between intentional fraud and unintentional errors. Intentional tax fraud involves deliberate actions to avoid paying taxes by misrepresenting or hiding information. This means there's a clear intent to deceive the tax authorities. On the other hand, unintentional tax errors occur without any intent to mislead. These mistakes usually happen because of misunderstandings or simple oversights. Understanding this difference is crucial because the consequences and how these cases are handled can be very different. Now, let's look at some of the most common tax fraud schemes. First, underreporting income, which involves deliberately reporting less income than actually earned to lower taxable earnings. This is one of the most straightforward and frequent methods people use to avoid paying the correct amount of tax. Next, we have inflating deductions and claiming false credits. This means exaggerating expenses or fabricating credits to reduce tax liability. People might, for example, claim deductions they don't qualify for or create fake expenses. Then, there's concealing assets, often by hiding income or money in offshore accounts to keep it out of reach from tax authorities. This makes it harder for authorities to track those assets and income streams. Lastly, some individuals create fake charities to deceptively claim tax-exempt donations. These sham organizations exist purely to give a false appearance of charitable giving, helping to reduce tax owed illegitimately. Understanding these schemes is crucial in identifying and preventing tax fraud. Money laundering typically unfolds in three key steps. First, we have placement, which is where illicit funds are introduced into the financial system. This is often done through means like deposits, purchases, or other financial activities to move the dirty money into legitimate channels. Next comes layering, the most complex stage, where the goal is to disguise the origin of funds. This involves conducting a series of intricate transactions, transfers, conversions, or investments that make tracing the money's illegal source very difficult. Finally, we reach integration, where the now clean money is reintroduced into the economy. At this point, the funds appear legitimate and can be used freely without raising suspicion. Understanding these stages is crucial for detecting and preventing money laundering activities. When it comes to detecting money laundering, there are a few key methods we rely on. These include closely monitoring suspicious transactions, conducting thorough financial audits, and sharing information across institutions. This multi-layered approach helps us spot irregular activities early. On a global scale, the fight against money laundering is supported by a robust legal framework. Countries have enacted specific laws, signed international treaties, and developed cooperative enforcement strategies to work together more effectively. This legal backbone is crucial for creating a unified front. Finally, these coordinated measures across borders significantly enhance our capability. By collaborating internationally, agencies can better identify and dismantle complex laundering networks that operate across different countries, making it much harder for criminals to hide illicit funds. This collaboration is essential in tackling the global nature of money laundering.